right, listen up because I have a major warning for you today. Gold is finally ready. I mean, for weeks now, we've been watching gold just get completely rejected every single time it tried to rally. Sellers would just aggressively step in, push it right back down to fresh lows, and honestly, it looked pretty grim. But in the last 24 hours, something shifted. Gold is suddenly doing something it hasn't done in a very, very long time, and we absolutely need to figure out exactly what it means.
But hey, before we dig into the charts, we really need to talk about the noise. Seriously, are you as tired of the headlines as I am? We've all been watching this insane geopolitical whiplash in the Middle East. You get massive escalation one minute, and then boom, ceasefire mediators the next. It's just this endless, exhausting cycle of wars on, wars off. And let's be real, relying on these completely unpredictable headlines to make your moves is a terrible strategy. That is exactly why we need to strip away all that noise right now and focus on the hard data.
And that hard data leads us right to the ultimate mystery for today's explainer. After months of a relentless, punishing downtrend, gold just violently broke its downward trend line. So we're going to put on our detective hats today and find out, is this sudden surge a total trap? Or are we finally seeing the real deal? Are we actually looking at a genuine opportunity to catch a positive trend for the first time in what feels like forever? Okay, let's get into section 1, gold's critical breakout moment. To answer our central question, let's call our first piece of evidence to the stand, the technical analysis on the 4-hour time frame. Now, we absolutely have to acknowledge the elephant in the room here, the massive bearish history. This has literally been the strongest downtrend we've seen in gold in years. Get this, gold hasn't even managed to retest the 200-day moving average since this bull market kicked off way back in September 2023. So yeah, we have to respect the bears, they've been in control. But then you have this sudden, incredibly compelling bullish breakout of the downward trend line that just hit. It's a hugely encouraging start for the bulls, no doubt about it. So how do they actually win? Well, there's a very specific sequence of events the bulls need to pull off to definitively take control here. Breaking that downward trend line was step 1. Check. But step 2 is where the rubber meets the road. We need to see the price cross and, more importantly, actually hold above the 20 and 50 moving averages. It needs to find real support there instead of just getting smacked back down. Finally, step 3, we need a strong, convincing close above local key resistance, specifically the 460 area. If we get that closure and a pullback that holds, gold starts looking incredibly attractive. Right, moving on to section 2, decoding the options market. Let's call our second witness to the stand and look under the hood of the GLD ETF expiring on August 21st. If you're not an options trader, don't sweat it. It's actually pretty simple. Think of put and call walls as these giant, invisible force fields of supply and demand. They are basically just price levels where a massive amount of open interest is sitting. By locating these walls, we can see exactly where the institutional whales are parking their money, which gives us these critical, hidden levels of support and resistance. So here's the crucial takeaway. Right now, a massive call wall is sitting about 3.5% above where prices are right now. When we map that over to the gold spot price, it lines up perfectly with the 4,200 level. Make no mistake, this is a major line in the sand for the bears. If gold pushes up to 4,200, expect some serious profit taking and fresh selling pressure. But if the bulls can actually conquer that level, wow, it's a massive signal that they've won the longer-term war. On the flip side of that, we have our downside protection. There's a massive put wall sitting 3.1% below current prices. This maps out to a really critical support floor right around the 39.50 area for gold spot, which happens to be just below the prior lows. Knowing there's this huge built-in appetite to buy and defend the market at 39.50, that gives range-bound traders a massive, massive advantage. But here is where things get really spicy. Beneath the surface, the sentiment is incredibly skewed. The net options volume flow shows that put volume is just completely dwarfing call volume right now. In plain English, the crowd is overwhelmingly bearish. And here's why you should care. When everyone crowds onto one side of the boat like this, it creates the absolute perfect storm to disappoint the bears. Any sudden upward movement can trigger a violent bullish short squeeze, forcing all those trap bears to scramble and cover their positions, driving the price even higher. That brings us to section 3, macro forces fueling gold. We've got the technical breakout, we've got the explosive option setup, but now let's bring in our final core witness, the real-world macroeconomic fundamentals. Because recent economic data is painting a very, very specific picture. We've seen a whole round of cooler-than-expected inflation data, specifically core CPI and core PPI, the ones that strip out the noisy food and energy stuff. We've also had soft manufacturing and services PMIs telling us economic growth is definitely slowing down. Top all of that off with some really weak non-farm payroll jobs numbers, and you've got a fundamental backdrop that practically begs for a long bias on gold. It's a classic central bank macro domino effect. Think about it. Inflation cools off and jobs data softens. That's the first domino falling. That gives central banks around the world the green light to start cutting interest rates. When interest rates drop, borrowing gets cheaper, which ultimately acts like rocket fuel to spur global economic activity and demand. All right, let's wrap up with Section 4, Oil, Tech, and the Dollar. Now that our gold thesis is locked in, let's do a quick temperature check on some peripheral markets to see how they fit into this overarching macro narrative. Let's just breeze through this scorecard really quick. The British pound, actually looking fundamentally super strong right now. It's rocking a highly bullish +9 score thanks to better than expected UK PMIs and a potentially hawkish Bank of England. The US dollar, meanwhile, has shifted back to neutral after hitting solid support at the 100.5 level. But the real danger zone right now is the Nasdaq. With huge tech earnings looming, we are resting right on a razor's edge of critical support at the 28,400 level. You gotta be careful there. And speaking of tech, there is a totally wild, fundamental shift happening under the radar. Cheap AI coming out of China is actually starting to threaten global memory semiconductor demand. The logic is simple. If AI can be run cheaper and leaner, you just don't need as much expensive memory hardware. We are already seeing previous high flyers like Micron suffering these brutal 26 to 35% drops. And listen, if that 28,400 support on the Nasdaq snaps, we could easily see a 15% index drop, meaning the entire semiconductor sector could be staring down devastating 35% haircuts. Then, of course, we have to talk about oil, which has been on an absolute tear, surging a whopping 26% from its recent lows in just a matter of weeks. This insane volatility is being driven almost entirely by the whiplash of those Middle East ceasefire and escalation headlines we were venting about at the start of this explainer. But remember our rule. Trying to predict geopolitics is a fool's errand. Smart traders ignore the news and focus on macro demand and the charts. Right now, oil is staring down massive technical resistance at exactly $88. Tracking this 88 level gives you a very calculated edge. If it rejects there, we drop hard. But if it breaks above 88, we could absolutely trigger a massive run to fresh new highs. Now, before we sign off, I need to anchor all of this analysis with some real talk. Despite all these incredibly exciting technical breakouts and macro setups, capital preservation is literally the only thing that matters long term. The golden rules always apply. Keep your risk per trade incredibly small. You have to mentally accept that lower win rates and losing streaks are just part of the game when you're hunting for massive moves. The whole point is just to survive the drawdowns, so your account is still alive to catch those life-changing, outsized winners when the stars finally align. So we've reviewed all the evidence. The technicals and the 4-hour chart are breaking out. The options market is heavily crowded with bears just begging for a squeeze, and the macro fundamentals of cooling inflation and weak jobs data are providing the absolute perfect tailwind. Weighing all of this against gold's undeniably heavy historical downtrend, I want to leave you with this. With all these dominoes finally falling into place, is it time to stop waiting and finally get off the fence? Keep your eyes glued to those charts this week. Thanks so much for joining me on this explainer, and keep